Welcome to The Business Behind Your Business, the podcast where we delve into the financial strategies and insights that drive success for small and medium-sized business owners. I'm your host, Paul Sweeney, and in each episode we bring you expert guests who share practical advice, real-world experiences, and actionable tips to empower you on your business journey. Whether you're a seasoned entrepreneur or just starting out, get ready to uncover the secrets to success and gain valuable insights into the business behind your business. So a lot of business owners do the work, they run good businesses, and they still feel unsure about the numbers. Pricing, it feels like just a judgment call. Cash flow is full of surprises. And when it comes to value, whether that's for a loan or a future sale, you don't know. It's uncertain. But you just don't think about that. Most of the time, it's not a lack of effort. What it is a lack of clarity. And today we want to take more of a practical approach to this. And we're going to focus on three areas that tend to drive that clarity. So the quality of your financial infrastructure, what it actually means to be bankable, and what needs to be in place if you want to sell your business at a fair value. And look, today I'm joined by Jeff Glick. Jeff, he's a CPA and leads the US operations for Outsourced CFO, where he works closely with founders, CEOs, and leadership teams worldwide, but particularly in the States, to improve financial clarity and build some real value into the business. Look, Jeff's spent more than 3 decades working across private equity, hedge funds, high-growth companies, and now focused on helping businesses get to the point where the numbers actually support better decisions. And, his experience with working with some of these global companies and large-scale businesses, taking that and providing that opportunity, that experience and advice to SMEs these days is quite valuable. Look, funding, exits, growth, Jeff has been there. He's been helping businesses achieve that for over 30 years. And look, we're delighted, Jeff, to welcome you to The Business Behind Your Business today.
Thanks a lot, Paul. I appreciate being here. I'm looking forward to it. It's going to be a lot of fun. Believe it or not, it's going to be fun, even though we're talking about finance.
Well, look, I always enjoy these conversations because there's always something that we discover that is, commonplace across the globe, okay? Common whether you're in Australia, the US, South Africa, UK, or any other country. And there are common things that business owners are just not doing. But when you actually come down to why are they not doing it, a lot of the time it's because they don't know they can or they don't know they should. And we see that a lot. Now, you've had a lot of experience dealing with businesses that look they look really good on the surface. They present very well, but the numbers are a bit shaky. Why is it that we can see, and this is a question I get asked a lot as well, is if my business looks really great or that business looks really great, particularly if I'm about to buy a business, why don't the numbers match up? There's something missing.
Yeah.
Is that something that you're seeing a lot of when you're taking over the role of the CFO for a business?
It happens a lot where, what you have internally will get you where you are, but might not get you where you're going to. So what's the next step? And what you see in a lot of times, a lot of small, mid-sized businesses, they're focused on intellectual property, new products, marketing, sales, and they kind of forget about the whole financial infrastructure. And a lot of times what you'll see is their reporting is late, inconsistent, wrong, and they're not tracking key metrics or benchmarks, and the reporting is not strategic in nature. And when they look for their first a financial transaction, which could be a merger, an acquisition, a bank loan, or someone's knocking on the door to buy them, they're not getting the full value in their business. Because if your numbers are shaky, they're going to take a significant discount to your valuation. So that's the whole theory, is that you have policies, procedures, internal controls, and tighten up before you have to. And in the end of the day, you'll also be making better decisions because you have that information where if something's going down, you'll know it, and you don't want to wait 2 months to get those numbers.
So I think what we're hearing is, or what I've seen in my experience, and I believe that your experience is pretty similar, is that a business will prepare a set of numbers for, I guess, statutory obligations like tax reporting or audit reporting, but there are numbers that are not being tracked and measured in the systems because that system doesn't exist. Is that what we're meaning by when we say the financial infrastructure is missing? We seem to be producing reports that don't actually help us with running the business?
Sometimes not. Like if you're looking for metrics, KPIs, that's taken from your financial information. So if your information is not accurate, and all the bad things I told you about prior, it's garbage in, garbage out, and you're not making those decisions. A lot of times a company will model themselves out of the metrics of the KPIs of that industry. And if you're not tracking them, you don't know how you're doing versus the balance of the industry. And you also don't know how to price your services or your materials. So a lot of that is dependent upon that as well. And you don't have to track these, but you should. And, a lot of times if you go to a third-party accountant, they're just doing your taxes, and they just see this as a commodity service, and they're not adding value, and they are not a trusted advisor. And that's what you really need, someone to hold your hand and walk you through it, and to tell you things you might not want to hear, because sometimes the truth is hard.
Yeah. So you mentioned the third-party transactional accounting, so tax returns, statutory financials. Often that is transactional because you want a particular outcome, and that is delivered. But it's a very basic. It's sort of almost like I guess the ground floor with no structure on top of it. Makes it very hard to actually make decisions about running a business. So how do you get your pricing right, or how do you know how much cash flow you need? If you're not tracking those key indicators in your business, or you don't have a system that allows you to, it's the decision making that's really going to suffer. And is that one of the biggest reasons that business owners, create, I guess, that complexity or uncertainty in their business because they don't have a clear pathway of what their business is actually doing in terms of the financial performance?
Sometimes, if you're a first-time business owner and you're an entrepreneur, a lot of times you don't know what you don't know. It's not that they're ignoring it. They just don't know that they should be looking at it. They're so busy, building their business, hiring key staff, going out, selling. They don't have time in the day to look at their numbers. A lot of times their financial infrastructure got them to where they are, and it's not going to get them to where they want to be. They hired a bookkeeper. The bookkeeper's been there for 5 years, and the bookkeeper tracks 3 metrics: accounts payable, accounts receivable, and cash. And are they going to make payroll for the next 2 weeks? That's what they're tracking. But they're not tracking everything else, as in, margins, not total margins, margin per engagement. Sometimes I'll ask a business owner, what are your margins? And they'll say, it's 50%. I say, okay, well, how many are above 50 and how many are below 50? And they go, I don't know. I get my numbers from Bobby. And Bobby's been there, and especially if it's a second generation business, mom and dad founded the business, brother and sister took it over. They do great. They have a great lifestyle business, but it's not going to get to that next level because they're not getting the support that they need. And we use this example where, let's say somebody tells the business owner that their business is worth 10 times free cash flow. And so let's say it's producing $1 million of free cash flow a year. So it's a good lifestyle business, a very good lifestyle business. But now they think they want to sell, and they think it's worth 10 times that. Well, when you go do due diligence, people are going to say, wait a second, your tax reporting doesn't agree to your books, and there's no bridge between the two of them. There's inconsistencies. You you account for margin one way versus another way, and there's a lot of stuff in here that's personal, and it's a mess. Tell you what we'll do. We'll give you 7 times. So you just lost $3 million on value that you've been working hard and accruing. And if you spent, let's say, $100,000 to fix it, you could have had a 30x return on that investment. And that's what we tell people. Having good financial infrastructure is an investment. It's not an expense. And oh, by the way, what you might find is that your business will run better now because you have better information to make those critical decisions on a timely basis, not 3 months after the fact.
One of the things you mentioned there is you're talking about the second generation business that's still using the same bookkeeping process or even perhaps the same bookkeeper that they started with many years ago, but their financial systems and processes haven't grown or matured as the business has grown. And that seems to be something that's holding back that ability to grow and operate more efficiently, be a more attractive business to somebody else as well.
Absolutely. And it's hard. I mean, because this person's been there for so many years. They're part of the family, or worse, they are family. It could be someone's cousin. And we had these discussions where they want to sell their business or they want to expand their business. They want to get it to the next level, but they can't tell Bobby he's not the person to lead anymore. Well, Bobby is basically a good accountant, but is not a strategic leader. And that's something that they have to overcome. And a lot of times they ignore it. They kick the can down the street until it gets to a point where they have to do something. And what we tell people is you should be making these decisions 12 to 18 months at a minimum before you want to do something. You can't wait to change your infrastructure the day after someone knocks on the door and wants to buy you. Then it's too late. And then you just have to suffer the consequences. And in the United States, the Institute came out with a report recently that 6 million businesses will be sold in the United States for almost $10 trillion because the aging population of the baby boomers. They've been working hard. They've been working for 20, 30 years. Their private business is probably 80 to 90% of their net wealth. So they either want to hand it down to their children, when their children might not want in the business, or they need to sell it, and then they can pass those to their children, the proceeds, or they just want to have a great, crazy retirement. And they're not going to get there unless they do something, unless they have incredible intellectual property, and that's different. And we sit there and when we talk to them, do you have franchise value? And they say, what's that? And then we say, is your business worth anything without you? And they go, what do you mean? If you take 2 weeks vacation, will the business still be in business? If you leave, is there anybody who could take over for you? And that's another thing we instruct our clients to look at is bring on more people to take over for you. Because in certain businesses, the owner is the business. They're their clients. They've been with them for 20 years. They know all the customers. They know all the distributors. When they go in and have to buy something, the vendors know that. And they get better deals just because they're going to be around. But if they're not there, the customers might start walking because they might know them from business, from church, from the club, or wherever. And you need to start bringing in and build that franchise value, bring in the right financial infrastructure as well. And there's other things you also need to do besides all that stuff.
I think just in that McKinsey report, like, it's very interesting, and you've given some very good reasons there. I think a lot of people will think about, oh, well, that's just the US, but the situation globally is very similar with that aging population. I know in Australia that over 50% of small, medium businesses are owned by a single person over the age of 50. And they're all going to be looking to exit at the same time. So what's the point of difference between your business and somebody else? And I think this is one of the leads into the question. We mentioned this phrase right at the beginning about how we can make our business become more bankable. Before we actually dive into what we actually mean by that, or how we do that, what do we actually mean when we say our business is bankable? Just so we're all talking on the same page.
I define bankable as somebody wants to loan you money, or someone wants to invest in you. That's how I define bankable, that you can undergo significant due diligence. You can undergo buy-side due diligence, that's bankable. And they start looking at your business for the right reasons, and they eliminate operational risk. It's okay, if you're being bought by a PE fund or a VC fund or someone who's done a lot of acquisitions, they could live with business risk, that somebody might develop a better product. But what they can't live with is operational risk. And that's where it's bankable. So they might say, okay, you know what? You have a great intellectual property, you have great products, your interior stinks. We trust you. Let's do an earn out for 5 years. And the person goes, what do you mean? I'm going to have a boss now? And the guy goes, yes. And, and we try to tell people, like, people invest in people, not always in companies. And so you have to, if you're going to be around, I'm the person to do this. This is what we've done. When we acquired ABC Company, we bought it, we got rid of all the problems, and our return on invested capital for this entity is 4x or 5x or whatever it is. We did a good job. We bought another company that didn't do so well, but because of our financial infrastructure, we cut the cord quick and only lost 1x, where it could have been a disaster. So that kind of thing is, do you trust the people? Are you bankable? That's how I define bankable.
Yeah, that's a good way to look at it, because there's so much tied up in the value of the business that people forget about. And it's one of their biggest assets. So how do you maximize the value of that going forward? And as you gave us some great examples there of the business that was well run, worth more. You could exit from it quickly. You could realize a much better return against the one that's doesn't have the operations, doesn't have the infrastructure in place, and not going to generate. If somebody is looking at this and thinking, well, how do I take the first step? Mm-hmm. What would you be saying to them when you go in? They've just appointed you as their external CFO. You've walked into the business. What's one of the first things that you would change? Because I think sometimes there's some quick wins that we can, implement to get some runs on the board very quickly and turn things, start moving around. What would be the first thing you're looking for to help that business change quickly?
Well, the first thing I would do is put in some pretty basic policies and procedures on cash management. Every bank account has to be reconciled. Every credit card has to be reconciled. Nobody can spend any money without it being properly approved. Somebody at a high rank has to approve it, because we have to assume there's a cash crunch just taking over day one. Then after that's somewhat stabilized, then I would do a sell side due diligence. Either we'll do it internally or we'll hire a firm, and the firm could be a small firm or whatever size it is that's appropriate. And let's take a hard look at how we do things here. And then what you do is you say, okay, which ones are the big problems and which ones are the not material problems? And let's focus on the big ones first. And let's take care of those problems. Those that have the biggest risk of disaster and those that are holding us back from really growing our business. Because you have to put on the hat of the acquirer. What are they going to do when they do their due diligence? Maybe have a quality of earnings light type of a thing where let's know the answers before they're asked. Because when I went back, it says people invest in people. If you say, yes, I know we have this problem, we're working on it, we realize we need to take care of it, we've been working on this for months or a year, and it's going a lot better and it's improving, that might help the situation. Or it might say there's a problem, but at least you have the answers and there won't be a surprise, and then they could adjust appropriately. So that's how I see it.
So you mentioned that looking at it from a selling perspective. I guess one of the objections that I hear regularly is, but I'm not planning to sell. Why should I think about changing things for a sale? But I want to go back to one of the comments you made earlier on in our discussion, where you mentioned that when you've got a business that's more attractive to a buyer or even more attractive to a financier willing to lend you money, it's going to operate more efficiently and be more profitable. Why do you think that there's so much resistance to looking at your business from that sell point when it translates usually into a stronger profit position, stronger cash flow in the interim before that sale point?
Because a lot of times they're focused on intellectual property, sales, marketing, and they think accounting and finance is just an expense. And they really have to be taught that financial management is an investment in your business. I mean, the same business could be operating the same way, but one's going to get 4 times and one's going to get 7 times. And how much is that 3x worth to? Because you're taking away a certain amount of risk and you're making decisions based on good information. Garbage in, garbage out. You can't rely on bookkeeping that's on Excel. And a lot of big businesses do that. It's incredible. Or they have, one system for this, one system for this, and they're not automated. They don't talk to each other. One group, like marketing has their spreadsheets, accounting has their spreadsheet. No one's making sure that they all agree. Manufacturing has their system. And maybe they need like a mini ERP system. I don't know. And you can get things a lot less expensive these days, but you need to do it right. And that's the key, because you need everybody to be on the same page. Everybody has to be looking at the same numbers, because when you go into a meeting and everybody starts taking out their reports and management goes, wait a second, accounting says this, manufacturing says this, sales say this. They should all be saying the same thing. And a lot of times they don't. And you have to have it in your corporate culture to have everybody on the same page.
Mm-hmm. And look, speaking of having everything on the same page, like you mentioned, the systems are a lot more accessible and affordable, particularly for small, medium business these days.
Yeah.
But some common things there is that we've often got an established business with still using the bookkeeping financial systems that they had in place when they first started.
Yep.
But we also have that resistance because we're focused so much on the day-to-day operations and the marketing and the chasing that activity rather than thinking long-term. I'm guessing from the fact that so many businesses stay in this trap and never progress beyond this, that the solution does not lie within that business. The solution lies in bringing in the skill and the expertise and the perception of what needs to change and what needs to be done needs to come from outside the business. And I guess, that is what you do. And you've had some amazing success with businesses where you've walked into that situation. How does that work in practice for a business? So I know I've got issues. My bookkeeper's been here longer than I have. I'm not moving forward. I'm getting old. I want to sell my business. But Jeff, I need your help. How are you going to help me?
You have to start from the beginning, and you have to make sure, as I said before, start with the basics and then add to that. There's a lot of systems in place for accounts receivable, accounts payable. They all migrate nicely into Xero, Zoho. In the United States, 90% of all small businesses are on QuickBooks. So you have to have that the right way. And then you start saying, okay, how can I be more efficient so the people who are in the trenches have more time to think and they're just not typing in transactions? I mean, the people you have might be fine. They just no one's ever told them to do things a different way. And to reiterate, this is a investment. It's like buying a new truck. It's like buying a new scanner if you're doing scanning for roads. This is a investment in your financial infrastructure, building value from within. And it's hard because they're saying, oh, I'm cash strapped. I don't have the money. What happens if it doesn't work? Joey, Bobby, Sally, Nancy says, everything's okay. We got it, boss. Don't worry. And the boss is scared, doesn't want to upset them because it's the culture of the business. And it's very difficult. And it's fully understandable. But there are ways to do it where you tell the people, this is going to help everybody. We're not going to lose jobs. We're going to make your job easier, and you're going to learn new skills. Now, maybe if they've been there for 20 years, they don't want to learn new skills because they could do this in their sleep. But they have to be able to get that information on a timely, accurate, consistent basis. And it's hard. But the owner has a nice lifestyle, and it's good. But if you have a younger person coming in, like their children, and they've been working for a couple of years, they're going to come in and say, what the hell's going on here? Well, let's fix it. And that's a lot of the times that what we see. When the third generation is coming in, they don't want it to die, the company. They could salvage it. So let's salvage it now while we have the funds to do it. And we won't take really nice vacations for this year. We'll spend the money in accounting, boring stuff. And that's what happens. And then hopefully after they do this, it's done right. Now they can start making decisions to really help the company. And all those people who've been there for 20 years, they have so much institutional knowledge that you also don't want to lose because they know where all the bones are buried. And so you really have to start thinking about how to handle it. And there are ways to do it and there's ways not to do it. It all depends. And what works for one group isn't going to work for the other group. And you really have to understand the people and be that trusted advisor where they're going to come to you and say, I got this problem. How should I handle it? And they haven't been getting that because the people that they're hiring were hired to do a task, not to be their advisor.
Yeah. So looking at what we've covered today, we've cleared up some, I guess, misconceptions about what financial infrastructure is, or what, more particularly, what a good financial infrastructure should look like, and how that's a first step to becoming a more bankable business, and getting that fair value when you do get that time to sell or exit from your business. All seems to be coming back to, I guess, one key thing is that clear numbers reduce stress, improve decisions, improve operations, And they also make it easier for other people like your banks, your buyers, even your key staff to trust what the business does and to do it better, I guess, and support that. So, Jeff, very clear, very practical approach. How do our listeners find out more about Outsourced CFO and what you do, and how do they get in touch with you?
So pretty simplistically, our website is ocfo.com. Can't make that any simpler. My email is jeffrey@ocfo.com. You can find me on LinkedIn at Jeffrey Glick CPA. And if they can't find us, they could ask you.
Yeah, absolutely. And if you can't remember those references, they'll all be in the show notes where you can look them up at your leisure, and also on the businessbehindyourbusiness.com website, where you can find the show notes for today's episode and all our past episodes. So, Jeff, look, I thank you for coming on today and explaining something very clearly that I think a lot of business owners are really missing. And once they get that understanding, they can start to make that decision to move forward. But also, thank you for making it so practical. And I guess because so much of what we talk, accountants have often been accused of talking in non-understandable financial jargon. But today, you've made that very clear and very understandable for everyone. Appreciate you doing that, and for showing us just how important it is to get that infrastructure in place.
My pleasure, Paul. I enjoyed it, and hopefully the people who listen will make the right call, and they'll start looking at their infrastructure a little harder.
That's a wrap for this episode of The Business Behind Your Business. We hope you found today's discussion insightful and valuable for your business journey. Before we go, don't forget to subscribe to our podcast on your favourite platform. Share it with fellow business owners who could benefit, and send in your burning questions, because we love hearing from you. Missed any of our previous episodes or looking for additional resources to help grow your business? Head over to our website at thebusinessbehindyourbusiness.com. There you'll find our full archive of past episodes, along with show notes, transcripts, and links to valuable resources mentioned in each episode. Your journey to business success continues at thebusinessbehindyourbusiness.com. Until next time, stay inspired, stay informed, and keep building the business of your dreams.